Good morning. We're going to wait about another minute just to allow some people to join, and then we'll get started. Thank you. All right, good morning. Thank you for joining us for our second quarter 2024 crude market update. My name is Jim Simpson. I'm the CEO of East Daily and also a member of the Crude Oil Supply and Demand Analytics team. And I'm joined by Director of Crude Oil Supply and Demand Analytics, Christy Olzak. And our topic this morning is return of regional diffs, and we're going to focus on Permian, Canada, and the Bakken, Guernsey, DJ area. So what we do is who we are. We serve analysts, researchers, and decision makers in two ways. One is efficiency, connecting, correlating, and modeling data. Two is confidence, to execute the decisions that you want to make. We connect the data, build the models, and think through the logic that our clients would have done anyways if they had endless amounts of time. We deliver data. We deliver reports, presentations, models in our BI platform, Energy Data Studio. We have an analytical support team, and we also do consulting. So we focus on supply and demand analytics as well as commercial analytics. So connecting supply, demand, and profitability through infrastructure data and market analytics. So we start on the left-hand side with company financials, and we focus asset by asset on midstream companies. By doing midstream, it allows us to have incredible insights into both upstream and downstream assets. We focus on natural gas, macro and regional supply and demand analytics. We focus on natural gas liquids, again, macro and regional, as well as purity products, supply and demand analytics. And we focus on crude oil, on macro and regional supply and demand analytics. Regional differentials return. Permian, second half of 2024, both natural gas and natural gas liquid constraints lift. That allows crude oil growth to intensify, and we believe Midland is going to widen more so than the forward curve would currently anticipates. Two, we're going to go through Canada. Producers fill the gaps created by TMX, and again, we think WCS should be wider than the current forward curve. And three, Bakken. That Bakken growth fueling egress constraints from the Bakken down to Guernsey, Guernsey into DJ, where a fight for DJ barrels ensues, tightening that price. So I want to start by focusing on 2024 and 2025 U.S. crude oil production growth. So average 2023 to average 2024, we see Permian growing by 350,000 barrels. The Bakken and DJ combined growing by 80,000 barrels, and all the other regions, including offshore and Alaska, growing by 30,000 barrels. That's a total of 460,000 barrels a day of growth, with Permian being 350,000 barrels a day of that growth. Now, when we get to 24, average of 2024 to average of 2025, we see Permian growing 530,000 barrels, Bakken and DJ growing, net declining 10,000 barrels, with growth happening in the Bakken, but declining in the DJ. So that is going to create some opportunities for a total 2024 average to 2025 average of 570,000 barrels a day. with Permian being the lion's share of that at 530,000 barrels a day of Permian growth. Now, when we dial in on the Permian, we have a natural gas Permian egress relief coming. So this graphic is Permian residue gas, and the black line is total capacity. The dotted line is where we are today. And we can see, and everybody I think at this point is well aware of how wide Waha it trades to Henry Hub currently. Well, we are at capacity almost every day. It's very hard to get gas out. Then in September, we get Matterhorn. Matterhorn creates natural gas relief. And then by the end of 2026 into 2027, we start to get tight again on the gas side. So Matterhorn gets us 18 to 24 months of natural gas egress relief. So in the Permian, not only have we had a natural gas egress constraint problem, we've also had a natural gas liquids egress constraint problem. So in this graphic, the black line is capacity, and then we've got total Y-grade capacity out of the Permian going to the Gulf Coast. We've got Y-grade flows. In the red line is our utilization. Red with white dots is our utilization. And as we approach today, we can see utilization gets almost to 100%, and flows, of course, are hitting capacity. At about the same time Matterhorn comes online, both Targa and Energy Transfer have Y-grade expansions. And then as we get into the Q1 2025, we see Epic, Enterprise, MPLX, and ONEOK all coming on with expansions, allowing us plenty of Y-grade relief out of the Permian. So not only have we had a Y-grade constraint problem, we've had a fractionation capacity constraint problem. The red line is capacity, the blue is net supply to Texas Gulf Coast fractionators, and the green is utilization. So we can see we run almost every day well above 100%. And then as we get into the back half of 24 and into 25, we start to have Targa, ONEOK, Enterprise with fractionation expansions and some relief there. Similar to Matterhorn, that gets us a good 18 to 24 months of relief on the NGL side. So with gas constraints lifted and NGL constraints lifted, that allows us to focus, or we're going to focus now on Permian crude egress and that 350,000 barrels of growth and that 530,000 barrels in 25, and where and how that's going to impact price. So I went ahead and I just put in last Friday's settles for average settles for WTI for 2025. So WTI was 74.57. Midland was a positive $1.27, and Houston was a positive $1.85. It costs roughly $1.25 to $3 to go from Permian to Corpus, about the same to go to Houston or Nederland, $1.25 to $3, and to go from Cushing down to Houston is anywhere from $1.75 to $4. So the graph on our left is Permian to Gulf Coast egress. You can see in the bottom, in the grayish green areas, flows to Corpus Christi. The orange is Houston, and the yellow is Nederland. And the gray line is capacity, and the black line is total utilization. My blue arrow is where utilization goes above 90% and stays above 90%. Again, this is Permian to Gulf Coast. So by year end this year, year end 2024, we are above 90% utilization Permian to Gulf Coast. Typically, when we see utilization get above 90%, that's when we see spreads start to widen and pipeline capacity become more valuable. The graph on the right is total Permian egress. So now I've included Cushing in that top kind of greenish gray area. When we draw our capacity line, that little bump in capacity is Seminole NGL pipeline Y-grade converting back to Midland to Echo 2 back into crude oil. And we can see now with total Permian egress by the second quarter 2025 is when we get above 90% utilization and we stay above 90% utilization. So again, as we approach and get above 90%, that's when we start to see pipeline capacity become more valuable and i.e. spreads widen out. Now, one other piece that is happening or interesting thing that's happening in the Permian, this is a graphic from Energy Data Studio. And we can see on the right-hand side of the graphic, as flows approach capacity, at that same time, we have minimum volume commitments on long-haul pipes, particularly Permian to Corpus Christi. Those contracts start to roll off. So again, it's a good situation for pipelines as they are potentially able to recontract at higher rates than where the spread is trading now. Again, we think about where it was last Friday. It was roughly 55 cents to go or from Permian to Houston. And as we start to approach 90% egress is where we should start to see, again, pipeline capacity become more valuable. At the same time, we see contracts rolling off. So when we think about Permian again, that second half of 24, natural gas and natural gas liquid constraints lift. That allows crude growth to intensify. And then Midland should widen both to WTI and to MEH. So in my graphic, I've got the blue line is Midland to MEH, both historical and the forward curve from CME. The red line is Midland to WTI. The dotted blue line is our Permian to Gulf Coast utilization. So if I draw a line at 90% utilization, I can see over on the left-hand side of the graph, in 2019, when we were above 90% utilization, Midland to TI traded anywhere from -$1 to -$3, and Midland to MEH traded anywhere from -$7 to -$10. My box on the right-hand side is highlighting in the future where that Permian to Gulf Coast utilization goes above 90%, and we believe there's as much as $2. So Midland to WTI should trade down or widen as much as $2 more than where it is currently in the forward curve. And Midland to MEH also should widen, has an additional $2 of pressure or widening between Midland and MEH. So with that, we're going to turn over to Christy Olzak, and we're going to focus a little bit on Canada and the impacts of TMX.
Well, good morning. I am going to jump right into Canadian production, and with Canadian production, it will lead to TMX coming online and ultimately the impact on price. So to start off with, in 2023, the Western Canadian Sedimentary Basin, the WCSB, was producing 4.3 million barrels. On average, between 23 and 2024, you saw enormous growth in the oil sands specifically, about 210,000 barrels a day of growth, and the lion's share of that was in the synthetic crude production. In the fourth quarter of 2023, there were a few efficiency projects at the upgraders, which really caused the uplift in the synthetic crude. Now, from 2024 to 2025, you're seeing another 4.5% growth in Canadian production. Again, it's almost exclusively in the oil sands. 95% of it is in the oil sands. But what you're seeing different in 2024 is that the growth is in the non-upgraded production rather than the synthetic crude. So overall, you're seeing 300,000 barrels increase from 23 to 24, another 200,000 to 25. So that's getting you to growth from 2023 through 2025 of 500,000 barrels a day, 500,000 barrels. So where is all that production? How is it going to get to market? Well, I wanted to talk about TMX. So TMX is a Trans Mountain expansion project. It is line 2. It is the twin of the Trans Mountain pipeline. Trans Mountain pipeline runs from Edmonton, Alberta to the Vancouver area of British Columbia. Specifically, TMX will deliver solely to the Westridge Marine dock. That dock is earmarked for exports to Asia, to China, and also to California. Now, as TMX is coming online, we will see reductions in other Canadian pipelines heading into primarily Pad 2 and Pad 4. However, we're not expecting any significant market disruption. It will not impact refinery supply. We think the refinery supply will surely make it through Pad 4. No disruption in Pad 2, no disruption in Gulf Coast refiners. Where we're anticipating seeing a little bit of the reduction in volume is on the Gulf Coast, and it's the barrel that the U.S. is re-exporting, if you will. And possibly it's better to look at it as those barrels are just being transferred to the west coast of Canada for export. And how will all of this now impact how TMX is filling up? So I want to look specifically at TMX as it comes online. So I'm going to start off with looking at production again. So this is the non-upgraded production from 2023 through 2026. The oil sands. This is the 18 to 24 API heavy sour. This is the synthetic crude, again the oil sands, but upgraded into a light sweet crude, your conventional, your imported condensate, and your capacity line. So in 2023, throughout that calendar year this time, you saw the growth in the oil sands, and ultimately you had record production in 2023. They ended the year with 4.67 million barrels of production. As TMX comes online May 1st, it's scheduled to come online in just a week. East Daily's view is that it's going to start off at 350,000 barrels a day, a little bit below minimum the MVCs of 80% or 470,000 barrels a day. But we believe there's going to be a few little kinks to get out of that pipeline. There's a lot of Aframax vessels in and out of Vancouver Harbor that will probably need a little bit of organization. So we think by first quarter of 2025, you will then see TMX ramp up to 525,000 barrels a day. And again, that will be over the minimum, the MVCs of 470,000 barrels a day. Of that 525, 295,000 barrels a day will be of Canadian growth. And again, about 150,000 coming off of Enbridge Mainline, 20,000 coming off of Keystone, a little bit coming off of rail, and a little bit coming off of Express. I wanted just to talk about the volume coming off of Enbridge Mainline. 150,000, 200,000 barrels a day seems like a lot, but if you put it in perspective, Enbridge Mainline right now, with the big uptick in Canadian volume, is bursting at the seams. It cannot take another barrel. It is moving 3.2 million barrels a day. So if you take off 150,000 to 200,000 barrels a day, that pipeline is still over 90% and is still at full capacity. So I wanted to put that into perspective a little bit. When we get to the end of 2025 into the beginning of 2026, we think TMX will kind of stabilize about 550,000 barrels a day. At this time, we're seeing TMX almost exclusively filled with Canadian growth, 520,000 barrels of Canadian growth, and the rest coming from reduced rail volumes. So not really long-term impact on any of the pipelines. So this leads to, how does this impact price? I'm going to start off with WCS. WCS is the Western Canadian Select price point for the heavy sour, very viscous oil sands production. So we're going to start off looking at mainline volumes, and you see at the end of 2023 through the first quarter of 24, the big uptick on volumes kind of goes down, and then it comes back up with TMX. The same with Keystone, a little bit more muted, and then you see it with Express as well, and capacity for the pipelines. This is the WCS price curve. So initially, I want to talk about the elephant in the room, the beating that WCS took during the fourth quarter of 23 and the first quarter of 24. So what happened there? You had the perfect storm in the fourth quarter of 23. You had record oil sands productions, and you had PADD 2 refiners doing extensive maintenance on their turnarounds. Specifically, the largest refiner, BP's Whiting Refinery, extensive turnarounds. So WCS with more barrels in the market took a beating. Then into the first quarter of 24, again, Whiting Refinery had a power outage, which made recovery from the initial beating a little bit more difficult. As TMX comes online May 1st, the forward curve is showing that that price differential is going to be flat. As TMX comes online, as barrels are moved to the West Coast, as you have more egress barrels, the barrels are flat. And within the first quarter, or within the third quarter of 2025, you see that forward curve even widen out a little bit. And then you see, the major tightening, about a $6 to $7 tightening of that price spread as the production grows, as the capacity is diminishing, as you see more congestion in the market. So EDA at East Daily, we look more to fundamentals. So our forward curve is showing that as TMX comes online, we're seeing a gentle ramp up, a gentle tightening as we get the fumes worked out of that pipeline to about 20%. So WCS, we indicate, is going to tighten by 20%. Then when the forward curve of WCS has that huge adjustment and tightens, we widen back out. As you have more barrels in the market, you're almost in oversupply of that heavy barrels. You've got more congestion, you've got more bottlenecks, it widens out. So we are very contrary to what the forward curve is saying. They're saying it will tighten out through 25 and 26, and we're showing it's going to widen. Lastly, I want to talk about the impact on sweet prices due to TMX. Specifically, I want to talk about the Clearbrook market in northern Minnesota. Now, the mainline delivers the heavy sour, the heavy oil sands production. It also delivers a light sweet barrel of synthetic crude. Also in the Clearbrook, you see the North Dakota pipeline delivering a light sweet barrel. Today, on mainline, you're seeing a 70-30 interface between heavy and light. So 70% of what's on that pipeline is heavy, 30% is light. When TMX comes online, you're going to see those heavy barrels move to the West Coast. So you have less heavy barrels coming on Enbridge mainline. Some of that space is going to be replaced with that uptick in Syncrude. So therefore, your interface on the pipeline will change. It will go from 70 to 30 to approximately 67 to 33%. We believe this will put downward pressure on both the Syncrude and also the light sweet barrels coming in from the Bakken, the UHC stream. Now, as TMX gets full, as Canadian production grows, it will change again, and you'll see that volume replaced on mainline with the heavy sour, non-upgraded. Now we think the synthetic will stay pretty stable. So again, that interface will shift back to a 69.31. And the forward strip on these prices, you can see where we're showing that there will be downward pressure. Now again, in the first quarter of 24, the sweet prices also were beat up by Whiting Refinery being down. And as those prices recover, they don't quite recover to the previous values. And with that, I'll hand it back to Jim to talk more about the Bakken.
All right, thank you, Christy. So again, in Canada, we believe producers are going to fill those gaps created by TMX. And as Christy said, we expect WCS fundamentals would indicate it should widen. So now on to the Bakken, where that Bakken growth is going to fuel egress constraints from Bakken into Guernsey into DJ, where a fight for those DJ barrels ensues. So I want to focus again back on 24 and 25 US crude oil production growth. So Bakken DJ from 23 to 24 is about 80,000 barrels, and Bakken and DJ from 24 average to 25 average is losing about 10,000 barrels. So again, 80,000 barrel growth between those two basins in 24, and a decline of about 10,000 barrels in both of those, or net in those basins in 2025. And again, Bakken growing, DJ declining is where there's some opportunities between Bakken down to Guernsey and then into DJ. So first, I just want to point out very quickly that Bakken, in a similar way to Permian, has a bit of a natural gas constraint. So this is a Bakken natural gas egress chart, and we can see that total production production into egress in the Bakken runs and through 25 runs pretty much at capacity. So again, that tempers our Bakken crude oil production, because the crude oil and the gas, of course, are highly correlated in the Bakken. So Bakken crude egress hits 90%. So I want to focus a little bit. We're going to start with Bakken production. And you can see in the dotted line, that's where we are today. And that's our growth. So when we think about Bakken growing, it's about 60 or 70,000 barrels a day of growth. And you can see that uptick from Q4 of 23 through 2024. And now where that Bakken production going is relatively critical. So North Dakota Pipeline, Enbridge North Dakota Pipeline goes Bakken to Clearbrook. And we can see that graph of flows versus capacity on the right. And there's just no incremental takeaway. It's full every day. We forecast it full every day, so zero incremental takeaway. Now, Bakken also on DAPL, you can go from Bakken to Patoka. So on the bottom left is our DAPL graph, and that's where we are today. And we can see DAPL approaches 90% utilization and then runs above 90% utilization through 25, 26, and 27. So Bakken growth and being able to take DAPL down to Patoka is really good. We think DAPL is a winner in all this. And then all those energy transfer pipes downstream of DAPL, all the way down to Nederland and then into Louisiana, kind of win along the way. So also out of the Bakken is Bakken to Guernsey. And that is that route is both Bridger Pipeline and Double H Pipeline. And again, the dotted line is where we are today. And downstream Guernsey, both Bridger and Double H run well above 90% utilization on, so on Bakken exports. Now, there is another route out of the Bakken, and we get a lot of questions on it, and it's Enbridge Bakken North. And it runs from the Bakken up to Cromer on Enbridge Mainline, down to Clearbrook, and then potentially down to Patoka, all on Enbridge Mainline. So this is Enbridge Bakken North. And we can see there's plenty of space between a total capacity of 149,000 barrels and where we have it flowing between 10 and 15,000 barrels. It is a last resort. It has an ugly netback. There are better ways and cheaper ways to get to Patoka than using Enbridge Bakken North up to Mainline and then down to Patoka, namely, of course, DAPL. So we believe Enbridge Bakken North stays relatively underutilized. When we add all this up and we look at Bakken crude egress, it runs between 90 and 90%, between 90 and 95% utilization. So Bakken ends up being quite tight when using effective capacity. So how does Bakken affect Guernsey? Well, again, we throw up Bridger and Double H, which are running at 90% utilization. And then we think of how do we get out of Guernsey? One is Pony Express, and that orange area of Pony Express are flows, it's Pony picking up volumes in the Guernsey area, taking them to Cushing. And most of Pony Express is made up of Guernsey volumes. Another route out of Guernsey is Cheyenne Pipeline to Cowboy Pipeline. Cowboy Pipeline is a bottleneck, and it is running essentially 100% utilization. And again, you can see that ramp up in the Bakken growth in Q4 of 2023, really supplying Cowboy. Cowboy is a feeder for Saddlehorn Pipeline. So in the blue, the light blue on the bottom of the Saddlehorn graphic, that's Guernsey supply from Cowboy. When we layer back in Pony Express and Pony's Guernsey volumes, and we add our DJ production and rig count graphic, and you can see that DJ decline in 2025, we can see both DJ volumes on Pony in that gray area and DJ volumes on Saddlehorn. Saddlehorn still runs almost 90% utilized, but that fight for DJ barrels leaves White Cliffs and Grand Mesa as sort of the second tier in this whole mix, with Saddlehorn, grabbing those DJ volumes, and then as well as Pony grabbing DJ volumes and being able to take those down to Cushing. So Bakken, again, that growth of Bakken fuels egress constraints from the Bakken down into Guernsey, down into DJ, where a fight for those barrels ensues. So with that, I would like to thank everybody for joining us this morning. We really appreciate your time. This is our new Permian crude oil supply and demand, which includes production, infrastructure, downstream demand, Corpus, Houston, Nederland, and also pricing impacts. We'd love to talk to you about it. You can scan the QR code. With that, please have a great day, and we really appreciate your time this morning.